Hey everyone, and welcome to this explainer. I am incredibly excited to be your guide today. Think of this as a masterclass designed to cut right through the absolute barrage of financial information we're hit with every single day, so we can finally find the true signals hidden inside all that noise. As a focused learner, you know that keeping your financial foundation strong means separating facts from fiction. So, grab a notepad, get comfortable, and let's dive into navigating today's financial minefield.
Take your little $2,000 from your tax return and turn it into $100,000 in 6 months. I mean, we've all seen claims exactly like this blowing up on social media right now. And honestly, I totally get the appeal. It's incredibly validating to want a fast track to financial freedom, especially when things feel economically tough out there. We see these flashy clips, the lavish lifestyles, and it's tempting, isn't it? But as your trusted advisor today, I've got to firmly, yet empathetically, remind you, the promise of easy money is almost always a trap designed to separate you from the hard-earned cash you already have.
Which brings us to the big question, is there a cheat code to wealth? Well, the short answer is no, there really isn't. Today, we're going to confidently separate the chaotic social media noise like copy trading and AI get-rich-quick schemes from the actual undeniable macroeconomic realities that are actively shaping your wallet. We are going to build a clear, actionable path forward based on facts, not fads.
Here is our roadmap for today. 1. The illusion of easy money. 2. The AI advisor experiment. 3. Cracks in private markets. 4. Navigating global economic shocks. And 5. Your actionable survival guide.
Let's jump straight into Section 1, the illusion of easy money.
Right now, people are flocking to platforms like Polymarket for copy trading bets. We're talking about things like wagering on the release of the Epstein files. Now, while we obviously have to unequivocally condemn the horrific exploitation surrounding that case, treating it as an opportunity for a quick 10% gain is not just morally fraught, it is financially reckless. You see, you're dealing with thinly traded markets here. When you bet on a highly probable event, your upside might be capped at a tiny 10%, but your downside? It is a massive asymmetrical 100% risk. If you put up $100, you might make 10, but one bad headline, one unpredictable variable, and your entire investment goes to literally zero. It's effectively just gambling masquerading as an investment strategy.
Moving right along to Section 2, the AI advisor experiment.
This comparison right here is absolutely crucial. Using an AI to manage your life savings is honestly a lot like Googling your intimate medical symptoms. Sure, it's convenient, it's incredibly fast, and hey, there's zero judgment from the other side of the screen. But look at the stark contrast in reality. A registered fiduciary is legally bound to put your interests first and actively manages conflicts of interest. An AI language model, it's literally just predicting the next logical string of text based on its training data. It has zero legal accountability and absolutely no fiduciary duty of care to you. If the AI hallucinates a bad stock pick or gives you terrible tax advice, there are exactly zero guardrails to protect your money. And to highlight just how risky this is, take a look at this number, 17.5%. Even the most advanced AI models, when benchmarked on challenging finance tasks, still have a 17.5% error rate. Let me ask you, would you trust a human advisor who is wrong almost a fifth of the time? Think about this. AI can still confidently tell you there are 0-letter E's in the word 17, all while aggressively insisting it's right. So relying on AI for a quick budget overview? Sure, that might be helpful. But handing over the keys to your financial future to a machine that routinely hallucinates facts? That is incredibly dangerous.
Which brings us to Section 3, cracks in private markets.
You know, you might have heard the term shadow banking tossed around. Well, this is exactly what we mean. Private credit involves non-bank investment firms raising capital to lend directly to private businesses. Following the 2008 financial crisis, traditional banks faced really strict regulations, and that forced them to step back from riskier lending. Private credit happily stepped right into that void, and since then, it has rapidly grown into this massive $2 trillion opaque market. But here's the catch. It operates with incredibly high fees and only a fraction of the oversight and transparency that traditional banks have to deal with.
And guys, that lack of transparency is starting to show some serious cracks. Defaults among corporate private credit borrowers have recently hit 9.2%. That is higher than pandemic levels. We're also seeing a massive surge in something called payment in kind. Now, this is essentially a struggling company paying its interest, not with actual cash, but by taking on even more debt or handing over shares of their own business. Imagine paying your credit card bill with another credit card. It's a huge red flag. High interest rates are aggressively squeezing these private borrowers, leading to situations where massive multi-million-dollar loans are suddenly being written off to near zero practically overnight.
So the crucial point for us is how this impacts everyday investors who are sold on these funds. It creates a massive liquidity trap. Because these private loans are not publicly traded, they are incredibly hard to sell quickly. When spooked retail investors all try to pull their money out of these funds at the exact same time, the funds are literally forced to initiate gated withdrawals. Picture a crowded theater where someone yells fire and everyone rushes the exit at once, but the doors only let one person out every 10 minutes. Your money gets trapped, completely illiquid, right when you might want it most.
All right, let's zoom out for Section 4, Navigating Global Economic Shocks.
Let's look at the undeniable global forces that are actually shaping your portfolio. First, the U.S. Supreme Court recently ruled that $175 billion in executive tariffs were illegal, completely upending trade costs and government revenue streams. Second, look at the sudden Canada-China trade deal. They're exchanging 49,000 Chinese EV imports for reduced tariffs on Canadian canola oil. That is a massive shuffle in North American trade dynamics. Finally, conflicts in the Middle East are causing severe disruptions to the Strait of Hormuz. All of these global trade shuffles and court rulings, they directly hit the everyday economy and the prices of the goods you buy at the store.
Let's look a little closer at that Middle East conflict. We are seeing recent, very aggressive price spikes for both West Texas Intermediate and Brent crude, pushing right up towards that $90 to $91 mark. The economic ripple effects here are just undeniable. Roughly 20% of the world's total global crude supply passes through the Strait of Hormuz. It's a narrow 33-kilometer choke point bordered by Iran. When shipping companies suspend transit due to military strikes in the region, the global supply chain tightens up immediately. And that means the cost of fuel, manufacturing, and transport for almost every product you consume goes straight up.
And honestly, the global equation is just packed with unpredictable variables right now. We have the looming CUSMA, or U.S.-Mexico-Canada Agreement renegotiations coming in 2026, which could completely rewrite North American commerce. The U.S. is rapidly replacing those illegal tariffs we mentioned with temporary 10 to 15% levies, which keeps import costs extremely volatile. We even see regional instability, like the fringe movements for Alberta separatism in Canada, shockingly involving discussions of $500 billion foreign loans. These highly charged political events act as massive variables that create deep, undeniable uncertainty in the global financial system.
So, what do we do about all this? That brings us to Section 5, your actionable survival guide. Here is your playbook moving forward. Step 1. Ignore the noise. Scrutinize any financial advice generated by AI and completely avoid the gambling disguised as copy trading hype. Step 2. Protect your cash flow. Make sure your investments actually have liquidity so you aren't trapped by gated withdrawals in opaque private credit funds. Step 3. Embrace the boring, consistent strategy. Diversify your portfolio globally across different asset classes. That is how you insulate yourself from unpredictable geopolitical shocks and sudden trade wars. True wealth building isn't about finding flashy cheat codes. It is about building a resilient, structured foundation.
I want to leave you with a final, somewhat provocative thought to mull over today. Look at your own investments, look at your own savings, and ask yourself honestly, is your portfolio built for reality or is it built on hype? Take the time today to reevaluate your financial foundation, stay educated, and remain vigilant against all that noise out there. Thank you so much for joining me for this explainer. Keep learning, stay focused, and I'll see you in the next one.